Cost, volume, slash profit analysis, or CVP analysis, is like the GPS for businesses navigating the complex landscape of financial decision-making. It's that essential tool that helps us understand how our costs, sales volume, and profits relate to each other. Imagine you're driving a car. You need to know not just where you're going, but also how fast you can get there without running out of gas or hitting a detour. CVP analysis does just that for businesses, guiding them through the often bumpy roads of pricing strategies, production levels, and profit maximization. At its core, CVP analysis helps us pinpoint the break-even point, the magic number where our total revenues equal our total costs. It's the point where we're neither making a profit nor incurring a loss. Why is this important? Because it provides a sense of financial stability. Knowing that we need to sell a certain number of units to keep the lights on is vital for any business. It's like knowing how much gas you need to get to your destination. Without that knowledge, you could easily find yourself stranded. Let's break down the components of CVP analysis. First, we have total revenues, which is simply the income generated from sales. It's calculated by multiplying the number of units sold by the selling price per unit. Next, we have total costs, which can be divided into variable costs and fixed costs. Variable costs fluctuate with production levels. Think raw materials and direct labor. On the other hand, fixed costs like rent and salaries remain constant regardless of how much we produce. Understanding the relationship between these components is crucial for making informed decisions. So, what are the key objectives of CVP analysis? One of the main goals is to identify the break-even point. This isn't just a theoretical exercise. It's essential for financial planning. It helps us determine how many units we need to sell to cover our costs if we decide to lower our prices or increase our production. This kind of analysis is invaluable for risk assessment as well. It allows us to evaluate the financial risks associated with different strategies and helps us set realistic financial goals. Another critical aspect of CVP analysis is understanding how changes in production volume affect total revenues and total costs. Typically, as production volume increases, total revenues rise, provided that the selling price remains constant. It's a straightforward relationship. More units sold mean more income. However, we need to be careful. If we decide to lower our prices to boost sales, we might end up in a situation where total revenues don't increase as expected. When we look at total costs, the picture becomes more nuanced. Variable costs increase with production, while fixed costs stay the same. This means that as we ramp up production, our variable costs will rise, but our fixed costs will be spread over more units, potentially lowering the overall cost per unit. It's a balancing act that requires careful management. Now, let's talk about contribution margin, the difference between total revenues and total variable costs. This metric is crucial because it tells us how much money is left to cover fixed costs and contribute to profit after covering variable costs. A higher contribution margin means we can reach our break-even point more quickly, which is why businesses strive to optimize it through cost-cutting or pricing strategies. Calculating the break-even point is relatively straightforward. The formula is simple. Divide fixed costs by the contribution margin per unit. This gives us the number of units we need to sell to break even. If we want to look at it in terms of sales dollars, we can use the contribution margin ratio. This analysis allows businesses to set targets and assess the financial feasibility of their operations. But what happens when we start to change the selling prices? This is where things get interesting. An increase in selling prices leads to a lower break-even point because each unit sold contributes more to covering fixed costs and generating profit. Conversely, if we lower our prices, we'll need to sell more units to reach that same break-even point. It's a delicate dance between pricing strategies and sales volume. When we assess the impact of price changes on total revenues and contribution margin, we see that it's not just about increasing prices to boost revenues. We need to consider market demand and consumer behavior. If we raise prices too high, we might lose customers, while lowering prices might attract more buyers, but could also erode our profit margins. Finding the right balance is key to optimizing profitability. CVP analysis also plays a significant role in budgeting and forecasting. By understanding the relationships between costs, sales, and profits, businesses can create realistic financial plans and budgets. This is essential for setting revenue goals, determining production volumes, and estimating costs. Including CVP analysis in the planning process helps companies allocate resources effectively and stay on track toward their financial objectives. In addition, sensitivity analysis is an essential part of CVP analysis. It allows businesses to assess how changes in sales volume, selling prices, variable costs, and fixed costs affect profitability. This analysis is crucial for identifying potential risks and opportunities. For instance, businesses can evaluate how economic downturns or shifts in market demand may impact their bottom line. By anticipating these changes, companies can develop strategies to mitigate risks and adapt to evolving market conditions. Ultimately, CVP analysis is more than just a financial tool. It shapes the very strategy of a business. It empowers decision-makers to make informed choices about pricing, production, and resource allocation. Companies that master CVP analysis are better equipped to navigate the competitive landscape, adapt to changing market conditions, and sustain profitability over the long term. In conclusion, understanding CVP analysis is essential for any business looking to thrive in today's dynamic economic environment. It's not just about crunching numbers. It's about making strategic decisions that drive growth and success. So, whether you're a small startup or a large corporation, embracing CVP analysis can provide the insights you need to steer your business toward a profitable future.